Interest rates up, stock markets down, government spending up, inflation out of control. So, who really runs the economy? Central banks or governments? The battle between monetary policy and fiscal policy is shaping the future of global finance. Today, I'm breaking down the hardcore economics behind these two forces and revealing who's really in charge of your money. Welcome back to Provocative Thinking, where I make complex economic concepts simple, but never dumbed down. If you want expert-level financial analysis, make sure to hit that subscribe button. Now, let's dive in. Monetary policy is the invisible hand that controls the money supply, interest rates, and inflation. It's managed by central banks like the Federal Reserve, the European Central Bank, and the Bank of Japan. Their job? Stabilizing the economy by controlling liquidity. Here are the monetary policy tools: interest rates. Raising rates cools inflation, lowering them boosts growth. Open market operations, buying and selling government securities to control liquidity. Reserve requirements, the amount of cash banks must hold in reserve. Quantitative easing, QE, printing money to flood the market during crises. Take 2022 to 2023, inflation hit a 40-year high. The Fed hiked rates aggressively to cool down spending. Result? Housing slowed, borrowing became expensive, and stock markets dropped. But did it actually solve the problem? Fiscal policy, on the other hand, is the visible hand, direct government intervention in the economy. This comes through taxation, government spending, and budget deficits. While central banks control the flow of money, governments decide where that money goes. Here are the fiscal policy tools: government spending, infrastructure, social programs, defense budgets. Taxation: cutting taxes boosts growth, raising taxes slows it. Deficit spending: governments borrowing money to finance programs. Look at 2020. Government spent trillions on stimulus checks, unemployment benefits, and business bailouts. While this kept people afloat, it fueled inflation by injecting excess demand into the economy. And who had to step in to clean up the mess? The central banks. Here's where things get messy. Central banks and governments don't always agree. Sometimes they're working against each other. Example, 2022 to 2023. The Federal Reserve was hiking interest rates to control inflation. The US government, meanwhile, was still spending on social programs and subsidies. Result? Conflicting policies made inflation harder to control. It's like driving with one foot on the gas, fiscal policy, and the other on the brake, monetary policy. The economy doesn't know whether to slow down or speed up. So, who really holds the power? The truth is, both and neither. Central banks can slow inflation but can't create jobs or invest in infrastructure. Governments can stimulate demand but can't directly control money supply or inflation. When they conflict, markets go into chaos, as we've seen in past economic cycles. The best outcomes happen when both forces align. A government that spends responsibly and a central bank that controls inflation without over-tightening creates long-term stability. Now here's the trillion-dollar question. Are we heading for a recession, or is inflation under control? Will governments keep spending, or will central banks push back harder? Drop a comment below. Do you think the Fed should keep raising rates, or has it done enough? Subscribe for deep dive economic insights. Like and share if you found this breakdown useful. Subscribe for more hardcore economics.